The average American in their 20s and 30s hands over more than 30% of every dollar they earn to the government, and most of them have no idea it's happening. Not because they're careless, not because they don't care about money, but because nobody sat them down and explained how the tax system actually works, or more importantly, how to legally keep more of what you earn. By the end of this video, that changes. I'm going to show you exactly how much you're really losing to taxes, why the wealthy pay a lower effective rate than most middle-class workers, and the specific accounts and strategies that anyone in the US or Canada can use right now to stop handing over more than they have to. Here is the number most people never calculate. If you earn $55,000 a year in the United States, your federal income tax alone is roughly $7,000. Add Social Security and Medicare, which is another $4,200. If you live in a state with income tax, tack on another $2,000 to $4,000, depending on where you are. And if you own a car, pay rent, buy groceries, or shop for anything. Sales tax and property tax, passed through your landlord, eat another chunk on top. When you add it all up, the average American earning $55,000 a year is keeping closer to $38,000 of it. That's nearly $17,000 a year gone, every year, before you even make a single financial decision. In Canada, the picture is similar. Someone earning 70,000 Canadian dollars will pay federal and provincial income tax, CPP contributions, and EI premiums that together can consume 25 to 33% of their gross income, depending on which province they live in. The number that should really hit you is this. Over a 35-year career, that averages out to nearly $600,000 in taxes for a middle-income American, more than $500,000 from one person working a regular job. And the question nobody asks is this: how much of that was actually unavoidable? The answer might surprise you. Here is what the tax system is actually designed to do, and I want you to really hear this. The tax code in both the US and Canada is not just a system for collecting revenue. It is a system loaded with legal incentives designed to reward specific behaviors. Retirement savings, home ownership, business formation, investment, healthcare contributions. The wealthy do not avoid taxes by breaking the law. Most of them reduce their taxes dramatically by understanding which behaviors the government rewards with lower rates and deductions, and then doing those things deliberately. Here is one of the most important facts in personal finance that young adults almost never learn. In the United States, money you earn from a job is taxed at ordinary income rates, which go up to 37% at the federal level. But money you earn from long-term investments, meaning assets you've held for more than 1 year, is taxed at capital gains rates, which max out at 20%. And for most people earning under about $44,000 a year, the long-term capital gains rate is actually 0%. Zero. That means a person who earns $40,000 from a salary pays a higher tax rate on that income than someone who earns $40,000 from selling stocks they held for a year. The system is not built against you, but it is built in a way that rewards people who know the rules. Canada has a similar advantage. Capital gains in Canada are only 50% taxable. So if you earn $10,000 from selling an investment, only $5,000 gets added to your taxable income. That is a significant structural advantage for investors over employees. The people winning with taxes are not cheating. They are just playing by a different set of rules, and those rules are available to everyone. Let me walk you through the specific tools that can legally reduce your tax bill starting this year. These are not loopholes for the rich. They are accounts and strategies specifically designed for everyday workers in the US and Canada. Tool 1. The 401k in the US, or the RRSP in Canada. This is the most powerful legal tax reduction tool available to working adults, and most people are barely using it. In the US, a traditional 401k lets you contribute up to $23,000 per year directly from your paycheck before taxes are taken out. That means if you earn $60,000 and you contribute $6,000 to your 401k, the government taxes you as if you only earned $54,000. You just legally lowered your taxable income by $6,000. Depending on your tax bracket, that could mean $1,000 to $2,000 less in taxes owed this year alone. In Canada, the RRSP works the same way. You can contribute up to 18% of your previous year's earned income to a maximum of 31,560 Canadian dollars in 2024. Every dollar you put in reduces your taxable income, dollar for dollar. Canadians who maximize their RRSP contributions can drop an entire tax bracket, which is a significant reduction in what they owe. And here is what makes this even more powerful. The money inside these accounts grows tax deferred. You do not pay taxes on the gains year over year. You only pay when you eventually withdraw in retirement, when your income, and therefore your tax rate, is likely much lower. Tool 2. The Roth IRA in the US or the TFSA in Canada. If the 401k and RRSP are about reducing your taxes now, the Roth IRA and TFSA are about eliminating your taxes later. And for young adults especially, later is where the real money is. Here is how the Roth IRA works. You contribute money you have already paid taxes on. You invest it, it grows. And when you retire and withdraw it, every single dollar, including every dollar of gains, comes out completely tax-free, not tax-deferred, tax-free. If you invest $6,500 a year into a Roth IRA starting at age 25, and that money grows at a historical average of 8% by age 60, you would have roughly $1.2 million, and you would owe $0 in taxes on any of it. In Canada, the TFSA, which stands for Tax-Free Savings Account, works almost identically. Your contribution room grows by 7,000 Canadian dollars every year. The money inside grows tax-free, and withdrawals at any age are completely tax-free, with no impact on government benefits. It is one of the most flexible and powerful wealth-building tools in Canada, and it is massively underused, especially by people under 35. Tool 3. The HSA, for Americans with high-deductible health plans. This one is genuinely the most underrated tax account in the United States, and most young adults have never even heard of it. A health savings account, or HSA, gives you a triple tax advantage that no other account in existence offers. Contributions are tax-deductible. Growth inside the account is tax-free, and withdrawals for qualified medical expenses are also tax-free. 3 layers of tax benefit in one account. You can contribute up to $4,150 in 2024 if you have individual coverage, or up to $8,300 for a family plan. And here is the part people miss. You do not have to spend this money on healthcare right now. You can invest it, let it grow for decades, and use it to cover medical expenses in retirement, when healthcare costs are typically at their highest. Effectively, it becomes a secondary retirement account with better tax treatment than almost anything else available. Tool 4. Tax loss harvesting. This one sounds complicated. It is not, and it can save you real money if you have a taxable brokerage account. Here is the concept. Let's say you bought a stock and it dropped in value. You can sell it, lock in that loss on paper, and use that loss to offset gains you made on other investments. In the US, you can even use up to $3,000 of investment losses to offset ordinary income each year. Any unused losses carry forward to future years. This is a legal strategy that reduces your tax bill by intentionally timing when you realize losses. The wealthy and their advisors do this routinely. Most regular investors have never heard of it. Tool 5. Simply understanding your effective tax rate versus your marginal rate. This is not a strategy. It is a mindset correction, and it matters more than people realize. Most people hear they are in the 22% tax bracket and think they owe 22% of everything they earn. That is not how it works. In the US, the tax system is progressive. You pay the lowest rate on the first chunk of income, a higher rate on the next chunk, and so on. The 22% only applies to dollars earned within that specific bracket range. Someone earning $60,000 in the US does not pay 22% on all $60,000. Their effective federal tax rate, meaning what they actually pay as a percentage of total income, is closer to 11 or 12%. Understanding this matters because people often turn down extra income, freelance work, or bonuses out of fear of moving into a higher bracket. But moving into a higher bracket only raises the rate on the dollars above the threshold, not on everything you already earned. Fear of tax brackets is keeping some people from earning more. That is a problem worth fixing. Here is the thing I want you to sit with for a moment. The tax code is over 6,000 pages long in the United States. No regular person is expected to know all of it. But the accounts I just described, the 401k, the Roth IRA, the TFSA, the RRSP, the HSA, those are not buried secrets. They are published, government approved, deliberately created to encourage the behaviors that lead to long-term financial security. The reason most young adults are not using them is not intelligence. It is not income. It is awareness. Nobody explained this in high school. Most employers mention the 401k once during onboarding and never bring it up again. And the people who benefit most from you not knowing these tools are the same institutions collecting fees, interest, and taxes on money you didn't have to give them. Every year you wait to open a Roth IRA is a year of tax-free growth you cannot get back. Every paycheck where you're not contributing to your 401k or RRSP is income being taxed at a rate it didn't have to be taxed at. The cost of not knowing this stuff is not abstract. It is specific. It is annual. And over a career, it adds up to hundreds of thousands of dollars. The good news is you are watching this now, which means you still have time. Before we wrap up, I want to ask you something, and I want you to answer honestly in the comments. Which of these accounts do you currently have open and actually using? A 401k or RRSP, a Roth IRA or TFSA, an HSA, or none of them yet? Drop your answer below. And if you have a question about any of these accounts, ask it. I read every comment, and I will either reply directly or turn your question into its own video. If this video opened your eyes to money you didn't know you were leaving on the table, hit subscribe. Every week on this channel, we break down the financial systems that affect your money, in plain English, with real numbers, so you can make decisions that actually move you forward. Next week, we are going straight into the Roth IRA and TFSA, step by step, showing you exactly how to open one, what to put inside it, and how much it could realistically be worth by the time you retire. You just learned something today that most people your age don't know. Stay ahead. I'll see you in the next one.